Hi, this is Steve Hutchinson with Hutchinson Family Office and with another video. It's a lot easier for me to do a video than it is to type out a 200 to 300 word email, which I think in most cases probably can get a little wordy. So what I'd like to do is put my ideas in a more concise pattern and give you an idea of what our firm is looking at and what we're taking a special interest in that might have an impact on you and your family's finances. First off, let's talk about last week. On Friday, the GDP was released. This is the first quarter look back at the GDP. It's an early number. It came in at about 2.3%. 2.0 was what was being expected, and quite frankly, 2.3 is a very, very good number. Regardless of what you hear on television or the talking heads, the first quarter GDP is typically a pullback from the fourth quarter. We see a little slowing down. We see slower consumer spending. We see maybe auto sales off a little bit. We see a lot of different things that affect that GDP on the first read. Now remember, this is the first read. We'll have several reads as it'll go through, and I expect the GDP to probably level out somewhere around 2.5 to 2.9. Would not be a terribly big surprise. I mean, the economy is growing very, very solid. Now, coming this week, on Friday, we've got a look back at employment numbers for April. We're expecting continued strength in the employment market. We expect to see more jobs that are being created than there are bodies to be filled. So we would ultimately expect to see a small incremental push-up in wages. I've been talking for a long time that I believe that wage growth was a major factor in the previous 8 years, 9 years, whatever, how far back, was something we weren't seeing. We were seeing a lot of new jobs coming online, but they were more of the paper hat type jobs. What we need to see now is we need to see good jobs, and we need to see the wages moving up across the board. So that's what we expect to see in Friday's report. Labor markets are continuing to be tight, and that will be reflected this week. But the employment numbers should show fairly positive. We expect probably an unemployment rate of around 4% or so, and so we're not really too concerned about that. Now, one thing about this quarter's GDP that you've got to really read between the lines. Don't take the headlines from talking heads or the newspapers or whatever, at face value. There's a lot of things that were not factored into this GDP number. First, the tax cuts weren't reflected in here. The tax cuts were not properly reflected, and they will be more properly reflected in the next quarter. So we'll see a little kick up from the tax cuts. Interest rates, a lot of chin wagging last week about interest rates, the 10-year note. We have said, I put it in writing, we are not the least concerned about the 10-year note. That is not something that we are worried about at this juncture. A 3% 10-year note is normal. And the problem is when you get back to normal, it feels unusual, okay? And a 10-year note at 3% makes a tremendous amount of sense at this level of economic development. I would say the economy will probably continue till we get to about 3.5 to 4. And then we should have some impact in the financial markets. Maybe the equities would pull back a little bit, but we're a long way from Fed tightening in that area. Now, when we take a look at the financial markets and we look at what's going on right now, what's been very encouraging to me has been the stabilization as we go through this correction pattern. Think of the correction pattern as a channel of data, a channel of market movement, and we've kind of bouncing off this bottom and bouncing off this top. And when we go through these types of channels, we look at the numbers very, very carefully, and what we're seeing is a stabilization. Now, some technicians use a term called a pendant formation, where you have like coming down like this, like a pendant. And then some folks are saying that this pendant formation might be a signal for a breakout. We would not be terribly surprised if moving into late summer, we see a significant move in the equity markets. That wouldn't surprise us at all. We think right now the markets are oversold, but we've gone on record saying that we believe that the S&P 500's got to move more towards the 15, 16 times earnings before we do see that breakout. So that's a number that we're keeping a watch on. You know, news announced last week about North Korea, South Korea getting together, talking. I can go back a year and everybody thought we were going to have a nuclear war. Much to do about nothing. Political policy is certainly paying off. And the strength of the Chinese relationship, the United States and South Korea, is bringing the North Koreans to the table under realization that something's got to change. That's very good for world markets. That's very good for global markets. And we see that as a positive impact. We had some bright spots last week. Amazon, very, very positive. Amazon is continuing to grow beyond delivering Tide Pods to the millennials, but also to increasing their sales not only in the web or excuse me, in the cloud. That's just there's tremendous margins in that business, and they're growing very, very strongly. In fact, there's an outside chance they may become more valuable than Apple Computer and may actually be one of the first companies to hit $1 trillion in valuations. We saw very strong numbers in Microsoft. Microsoft, a company that made most of its money selling Windows. Most people don't even know what Windows is today, but of course, you know, moving directions into their server and cloud operations has posted tremendous revenue opportunities there. Boeing. Boeing is getting, it's hard to go too many days without hearing someone ordering another load of jets. Now, there's been a lot of talk about tariff proposals, and we've been on record saying we don't believe there's going to be a trade war. We believe there's going to be some trade negotiations, but we don't believe there's going to be a trade war. And Boeing is benefiting from tremendous sales, and they seem to be, well, is Boeing going to do well? Well, Boeing's doing very well, and we're very happy with it. Visa came out with very good numbers last week. And the thing about Visa is that it gives us an idea of what's driving the consumer, the number of charges that are being made. Because as you well know, most of your transactions you may do in a business rarely involve a check or cash. Most of the time you just pull out the old debit card or credit card and everything runs through there. So there's a lot of financial transactions that are coming in. We're seeing a lot of strength there, and that's very positive. We had some disappointments last week. I mean, these disappointments really continue to stress us a little bit. We look at them very carefully. We're not ready to throw the baby out with the bathwater, but we are concerned about 2 or 3 companies, one in particular, Sherwin-Williams. Sherwin-Williams does not seem to make progress at this particular level, or at least the expected progress of its implementation of Valspar. Sherwin-Williams is a strong stalwart in the paintings and coatings business. We're seeing strength in housing. We're seeing strength in home ownership. We would expect to see Sherwin-Williams respond more favorably. We're going to stay with Sherwin-Williams. It's a strong hold at this particular time. We haven't made a decision to buy up on the weakness at this particular point. But that was a little bit of a concern when they failed to hit the numbers that were really expected. P&G is kind of taking us to task, Procter & Gamble. Procter & Gamble is a tremendous consumer product company. We're not seeing the sales and revenues that we would expect in there. We're going to keep our eye on Procter & Gamble. There may be a change coming down the road with Procter & Gamble in our portfolio allocations. We had a new one this week. Todd brought to the table United Rentals. Todd and I, for many years ago, we had United Rentals in some of our portfolios. We think that's a good, strong infrastructure stock. It parallels nicely with Caterpillar, which, by the way, did give us a little bit of a disappointment last week. They said everything was good, but that might be the best it gets. We'll see. and then of course John Deere. So United Rentals, John Deere, Caterpillar, those are kind of the companies that we have in the portfolio that kind of build on the infrastructure status. So that's kind of an update on the portfolio. Again, our key focus this week is going to be on the employment numbers. I want to point out that the employment numbers are going to be the first signal moving into this spring/summer economy. And we're hoping to see good, strong numbers. And we would anticipate that the financial markets will respond. Now, the last thing I want to talk about is going to be the three sectors that we feel the strongest about in investing. I'm asked this quite often. Yes, of course, you can buy equities and S&P 500 index futures or whatever it might be, or options or index funds. And we choose to invest in companies rather than just buy indexes. That's kind of a mindless trade, but sometimes it works better than stock picking. But that's not what we do. But the three sectors that we're the strongest in right now, I've already talked about senior housing. We believe the demographics are going to push that area higher. I think the second area that we're going to be taking a very, very strong commitment to is going to be in real estate, and that's going to be real estate other than big box retail or retail real estate. Retail real estate does not excite us at this particular point, but there are certain sectors in the real estate, industrial, office, those kind of things are starting to show some tremendous promise, and we are very open to that type of sector right now. And the third area is oil. Not natural gas, but oil. We're starting to see oil prices stabilize well above the $65 a barrel level. We're starting to see prices at the pump to reflect a good, what we call a good crack value. We're starting to see some really growth in the oil patch community of the United States. So we are very bullish on oil right now. So those are the three things that we're taking a look at. That'll do it for this week's video. Have a great week. I don't know if I'm going to be back on another one, but you'll know it when you get your email. Have a great one.